Dzień dobry Państwu, witam Państwa bardzo serdecznie. Czy mnie dobrze słychać? Czy mógłbym poprosić, aby Państwo także włączyli swoje kamerki i wypowiedzieli się, czy wszystko jest w porządku?
Tak, wszystko dobrze słychać.
No to super, rewelacja. Jak reszta?
Jest w porządku.
Jest w porządku. To super, fajnie, cieszę się bardzo. So welcome everybody on our special lesson using Zoom online. And at the beginning, we will start with our quiz using Kahoot. So I will try to show you site in Kahoot. Please tell me if you see it correctly. Czy wszystko widać, szanowni państwo? Widzicie państwo stronę Kahoot?
Tak, wszystko widać.
Super. So let's log into this application. And let's start, guys, if you are ready now. First question. Okay, so pledge means deklaracja. The next one. Okay, layoffs means zwolnienia z pracy. Very good. Next one. Okay, really good. Okay. Okay, and the last one. Okay, guys. Using chat, please write your names and your positions, please. From the first three from the podium, please write it. Now, let's start our today's presentation. Yesterday, you send me your presentation, and now the floor is yours. Using Zoom, you can also share your screen, and please try to start your presentation. Try if it is possible, and the floor is yours.
Już sekunda, próbuję znaleźć prezentację i udostępnić.
Dobrze, dobrze, okej. Okej, super. Także wszystko mam nadzieję, że jest widoczne. W takim razie oddaję Państwu głos. Proszę bardzo.
Ja się tylko upewnię, czy mnie słychać.
Tak, bardzo dobrze Panią słychać.
Dobra.
Tutaj koleżanka pisze, która miała zacząć, że wyrzuciły z Zooma, więc
Aha, to możemy chwileczkę poczekać w takim razie.
okej.
Jak? Czy wszystko udało się zalogować
Już
ponownie?
widzę, że dołączyła, tylko że nie wiem, czy nie mam problemów jakichś z głośnikiem. Sekundę.
Halo, tak, słychać mnie?
Okej.
Tak, bardzo dobrze Panią słychać. Dobrze, także oddaję Państwu głos. Proszę bardzo.
Okay, so hello to everyone. We prepared for you some presentation about fundamental of credit analysis, and if you allow, we will shortly present it to you. Okay, so the first and the most important question is, what is credit analysis indeed? And credit analysis is the process of determining the ability of a company or person to repay their debt obligations. In other words, it is a process that determines a potential borrower's credit risk or default risk. It incorporates both qualitative and quantitative factors. A credit analysis is used for companies that issue bonds and stocks, as well as for individuals who take out loans. And it is important that credit analysis is used mainly by three groups. And the first one are creditors, which are using it for determination a corporation's ability to pay back loans. The other group are creditors, using it to determine an individual's ability to pay back a loan or mortgage. And the last but not least group are investors who are using it to determine a corporation's financial ability. So a summary of credit analysis definition. Firstly, it is a process that determines the ability of a company or individual to fulfill their financial obligation. It is also a process that contains both qualitative and quantitative factors and the process that is used to determine whether a company or individual qualifies for a loan or mortgage. So why is credit analysis important? We should say that credit analysis is important for banks, investors, and investment funds. As a corporation tries to expand, they look for ways to raise capital. This is achieved by issuing bonds, stocks, or taking out loans. And when investing or lending money, deciding whether the investment will pay off often depends on the credit of the company. For example, in the case of bankruptcy, lenders need to assess whether they will be paid back. Similarly, bondholders who lend a company money are also assessing the chances they will get their loan back. Lastly, stockholders who have the lowest claim priority assess the capital structure of a company to determine their chance of being paid. Of course, credit analysis is also used on individuals looking to take out a loan or mortgage. Like the most famous is credit analysis, which takes place for loans. It is when a corporation is in need of capital. They can ask banks for a loan. Banks or creditors can be secured or unsecured. Here's an order of priority for claims during bankruptcy. Secured lenders have the first claim on assets used as collateral. They are followed by unsecured creditors. Of course, creditors would like to avoid bankruptcy scenario, which is why they utilize a credit analysis process to determine a corporation's ability to pay back the loan. Loans can also be given to individuals, and individuals also go through a credit check. We're talking about corporate loans. There are 5 C's of credit. It is used to determine credit quality during credit analysis. The first one is character, the second one capacity, then capital conditions and collateral. And in case of individual loans, there are credit scores, which contain mostly payment history and amounts owed, length of credit history, credit mix, and new credit. What are bonds? Bondholders look at corporations' bond rating to determine the default risk. Bonds that are ranked high are investment grade and have low default risk. Those that are non-investment grade are called high yield or junk bonds. They are dependent on favorable business, financial, and economic conditions to meet financial commitments. A company that already has high levels of debt will have a lower bond rating, as they are considered to have a higher level of risk. Bondholders are usually behind creditors for claim priorities, so in the case of bankruptcy, they have less claim on companies' assets. That's another reason why high levels of existing debt are a risk. And a few words about equity. Equity investors buy stock in a company and benefit from a rise in stock price and from dividends. The credit of a company affects investors in 2 ways: by the value of the stock and their claim on assets. Firstly, the value of the stock depends on the growth and stability of a company. Debt can drive investment and growth, but too much debt will decrease the stability of a company. If a company has too much debt, then the stock value will decrease due to lower perceived stability. On the other hand, if a company has no debt at all, then investors will wonder if the company has the ability to expand and grow. Credit analysis helps determine both the growth potential and stability of a company. The second concern for equity holders about credit quality is the claim on assets. Equity holders have the least claim on assets of a company in the case of bankruptcy. This is why the level of existing debt is important for equity holders as well.
Okay, so next question is what is a credit score? A credit score is a number. A credit score is a number representative of an individual financial and credit standing and ability to obtain financial assistance from lenders. Lenders use the credit score to assess a prospective borrower's qualification for a loan and the specific term of the loan. Essentially, it is used to determine the borrower's ability to pay back the borrowed amount in due time. Who uses credit scores? So any organization that lends money as a source of business uses credit score to assess the eligibility of a borrower. Such organization specifically include banks, credit card companies, fintech-based lenders, insurance companies, landlords, governments, agencies, and mortgage companies. What is a good credit score? A credit score ranges from 300 to 850. The higher your credit score, the better your standing as a borrower is. A respectable credit score is above 670. How to improve your credit score? So you can pay your bills on time. Paying off what is due on time consistently will establish your creditability as a borrower. You can also reduce your overall loan amounts. Proactively paying off more than what is due will ultimately help you showcase you as a creditable borrower who not only pays back, but who does so ahead of the due date. Next, you can manage credit cards effectively and don't buy what you can't afford.
Okay, so going to credit analysis ratios. So what are credit analysis ratios? Credit analysis ratios are tools that assist the credit analysis process. These ratios help analysts and investors determine whether individuals or corporations are capable of fulfilling financial obligations. Credit analysis involves both qualitative and quantitative aspects. Ratios cover the quantitative part of the analysis. There are four key ratios groups: profitability, leverage, coverage, and liquidity. Firstly, profitability ratios. As the name suggests, profitability ratios measure the ability of the company to generate profit relative to revenue, balance sheets, assets, and shareholders' equity. This is important to investors as they can use it to help project whether stock prices are likely to appreciate. They also help lenders determine the growth rate of corporations and their ability to pay back loans. Profitability ratios are split into margin ratios and return ratios. And margin ratios are gross profit margin, EBITDA margin, and operating profit margin. Return ratios are return on assets, risk-adjusted return, and return on equity. The leverage ratios compare the level of debt against other accounts on balance sheet, income statements, or cash flow statement. They help credit analysts gauge the ability of business to repay its debts. For leverage ratios, a lower leverage ratio indicates less leverage. For example, if the debt to asset ratio is 0.1, it means the debt funds 10% of the assets and equity funds the remaining 90%. A lower leverage ratio means less asset or capital funded by debt. Banks or creditors like this, as it indicates less existing risk. And the leverage ratios include debt to asset ratio, asset to equity ratio, and debt to capital ratio. Coverage credit analysis ratios measure the coverage that income, cash, or assets provide for debt or interest expenses. The higher the coverage ratio, the greater the ability of a company to meet its financial obligations. And coverage ratios include interest coverage ratio, asset coverage ratio, and cash coverage ratio. And last but not least, liquidity ratios. Those indicate the ability of companies to convert assets into cash. In terms of credit analysis, the ratios show a borrower's ability to pay off current debt. Higher liquidity ratios suggest the company is more liquid and can therefore more easily pay off outstanding debts. And liquidity ratios include working capital, cash ratio, and quick ratio. And that's gonna be all. Thank you very much.
Okay, so thank you so much, guys, for preparing this really interesting presentation. If it is okay for you, I can put this video with your presentation on our Moodle course. It is okay for you? If it will be available on Moodle course as a video file? What do you think, guys?
Yes, I don't have a problem with that.
Okay, so thank you so much for your voice in this case. Please be patient. In the next few days, I will send you 2 new articles to read, of course, in English, and we will start our next meeting from the quiz in KHAT as today. And we will talk about the things which are in these 2 articles. So I wish you all the best for this hard situation today, and thank you for joining our meeting today. And we will see next time on Tuesday at 1 p.m. the same as today. Is it okay for you? The same time as normal lecture? What do you think?
Yes, it's perfect.
Okay, and another guys? Is it okay for you?
Yes, that's fine.
Okay, so thank you so much for today, and have a nice day. Goodbye.